Hello and welcome to EY's latest video on the IASB's IBOR reform project. My name is David Bradbery and I'm joined by Tony Clifford. In this video, we shall be taking you through the IASB's recent publication, Interest Rate Benchmark Reform Phase 2 Amendments to IFRS 9, IAS 39, IFRS 7, IFRS 4 and IFRS 16. We will summarise the amendments, highlight the major changes since the exposure draft, or ED, that was published in April, and provide our view of the amendments. We're also producing a more comprehensive video running through all the amendments, including some worked examples, and that's available separately. So as a reminder, the IASB's work in this area follows the decision that was taken by global regulators to replace interbank offered rates, or IBORs, with alternative nearly risk-free rates, or RFRs. The IASB divided its work into two phases. Phase 1 addressed issues affecting financial reporting in the period before the replacement of an existing interest rate benchmark with an RFR. This phase was completed in September 2019. Phase 2 focuses on issues that affect financial reporting when an existing interest rate benchmark is replaced with an RFR. The exposure draft of the Phase 2 amendments was published earlier this year in April. In June and July, the IASB further discussed the proposals before the final Phase 2 amendments were published on the 27th of August. With publication of the Phase 2 amendments, the IASB's response to IBOR reform is now complete. I'll now hand over to Tony, who'll start to take us through the amendments.
Thank you, David. The first major change required by the amendments is that when you amend a reference to an IBOR, such as LIBOR, with a reference to a new benchmark rate, such as SOFR or SONIA, then that change is not treated as being a modification using the guidance and the standard, because that would then require you to record a catch-up adjustment to the financial instrument with an offset to profit and loss and to keep the original effective interest rate unchanged. Instead, the amendments require us to change the effective interest rate, which therefore means that we will have no adjustment to the financial instrument's carrying value. And this will obviously apply to any instrument that will be recorded at fair value through comprehensive income or at amortized cost. Now, however, there are some constraints. It applies to any replacement of an existing benchmark, such as LIBOR, with an alternative benchmark. It also allows for the addition of a fixed spread to compensate for any basis difference between the existing benchmark and the alternative benchmark. And also allows changes to the reset period, reset dates, or the number of days between coupon payment dates to affect the reform of an interest rate benchmark. As well as those changes to the actual documentation of the instrument, on top of that, other forms of modification could include changing the method used to calculate the interest rate benchmark. And here the IASB have in mind when IONIA was redefined last summer as being, going forward, ester plus a spread. That would be seen as a modification as well, but it would be caught by the same relief and therefore in the same way as a change in documentation as I've already described. That will be just treated as akin to a movement in a floating rate of instrument. The other form of modification that's possible is the addition of a fallback provision. Again, that does not cause any problem given the amendments to the standard. However, if any other modifications are made at the same time, on top of those directly required by IBOR reform, as I've just approximately detailed, and this could include a change in a credit spread or a maturity date, they have to be assessed to see if they're a substantial modification. If they are, the instrument will be derecognized. If they're not substantial, then the updated effective interest rate must then be used to recalculate the carrying amount of the financial instrument, with any modification, gain or loss, to be recognized in profit or loss. Now, there's no significant change here to what was in the ED. but it is the heart of a significant component of the changes, and therefore it's an important one to communicate and understand. As you're also probably aware, a similar practical expedient is being applied for leases under IFRS 16, so they can be accounted for in effect as changes in the estimate of the cash flows on the lease liability with an offsetting adjustment to the carrying value of the right of use asset, rather than using the modification language contained in the standard. Also, IFRS 4 is being adjusted for insurers that are still applying the IAS 39 financial instrument standard. So therefore, in this area, insurers are directed to look to the new paragraphs of IFRS 9 rather than the paragraphs of IAS 39. I'll stop at that point. David, back to you for hedge accounting.
Thank you, Tony. The next section then to outline relates to the reliefs given from discontinuing hedging relationships. The amendments allow hedging designations and hedging documentation to be amended for changes that arise directly from IBOR reform, without the hedging relationships having to be discontinued. Permitted changes include redefining the hedged risk to reference an RFR and redefining the description of the hedging instrument and the hedged items. Now, in response to feedback received on the ED, hedge designations must also be updated if derivatives are closed out and replaced on the same terms, but referencing an RFR, as long as the original hedging instrument is not derecognised. This is relevant for derivatives transacted via central clearing houses. The relief applies where the replacement derivative is entered into as a direct consequence of IBOR reform on an economically equivalent basis to the original derivative. For example, if the replacement derivative is entered into on off-market terms to match the original derivative in all respects, other than the change to the interest rate. The relief also applies if the original derivative is retained and a basis swap from IBOR risk into RFR is entered into, provided the basis swap can be individually linked to the original derivative. Importantly, the relief does not apply if the original derivative is closed out, the value settled in cash, and a new at-market derivative is entered into. Now back to Tony.
One of the elements of the ED which caused some concern amongst some respondents was the treatment of gains and losses on redesignating and entering into new hedging instruments. What the ED specifically had said was that if when you modify a derivative, there's a hedging instrument, or when you redesignate a hedged item, you need to calculate the gain or loss by reference to market prices, and then that could result in a small gain or loss being recorded in profit or loss. Now, I should emphasize we're talking about small gains and losses. However, some organizations with many hedging relationships worry that could add up to a significant sum of money. Well, what we now see in the final amendments is, in effect, no change to the treatment insofar as such gains and losses will be reflected in profit or loss. But you'll notice that a lot of this guidance has been removed. And that's because the amendments now require us just to refer back to the standard requirements of IFRS 9 and IAS 39, which mean that in the period in which the modification occurs, we just need to record the movement in the value of the hedging instrument and the hedged item. So if the hedging instrument changes in fair value during the period, partly because of a modification gain or loss that arises on when it's modified, that will just get caught up in ineffectiveness and therefore will be recorded in profit or loss. So the overall effect is the same as the ED, but worded more simply, just arising from the normal terms of the accounting standards. But it does mean that there could be some small amounts of ineffectiveness arising on transition. But I should emphasize that this is measurement ineffectiveness. It won't necessarily affect any of the assessments of whether hedges are highly effective. David, back to you.
Thank you. For the IAS 39 assessment of retrospective hedge effectiveness, the Phase 1 reliefs have been amended to end when there is no longer uncertainty with respect to the cash flows of both the hedged item and the hedging instrument. This is an editorial change, but an important one. IAS 39 has also been amended so that for the assessment of retrospective hedge effectiveness, entities can elect on a hedge-by-hedge basis to reset the cumulative fair value changes to zero when the exception to the retrospective assessment ends. The ED had proposed that all hedges should be reset on this basis, but feedback to the ED identified that this could actually increase hedge ineffectiveness in some cases. Therefore, the final amendments allow entities to elect the relief for individual hedges. Any hedge ineffectiveness continues to be measured and recognised in full in profit and loss as normal. Tony, back to you.
I'll now deal with two items that haven't been significantly changed since the ED. First, the rules for hedges of groups of items. And this applies where a designated group of items has been set up as the hedged item, such as if you're using a macro cash flow hedging strategy. And if these are amended for IBOR reform, the likelihood is that some of them will be amended at different times from others. And therefore, the relief allows the overall hedging strategy to remain and not be discontinued. But as items within the hedge group transition at different times from IBORs to the new risk-free rates, they'll be transferred to a subgroup of items that reference risk-free rates as the hedge risk. So you'll have two sub-portfolios, one which is still IBOR-based, one which is RFR-based. And at each transition, you're going to need to update any hypothetical derivative for the subgroup. So it's fairly straightforward. It just means that you can assess effectiveness by comparing apples with apples without having to worry unduly. But at the same time, it is a continuation of the overall hedging relationship. The other point is really a point of stress, is that as instruments transition to the new risk-free rates, the hedging relationship may need to be modified more than once. And the phase 2 reliefs apply each time a hedging instrument is modified as a direct result of IBOR reform. I think this is probably more clearly articulated in the final amendment, but there's no change actually to what was originally proposed in the ED. And finally, when the phase 2 release finally ceased to apply, once all changes have been made to the financial instruments and the hedging relationship as required by IBOR reform. David, back to you.
Thank you. For separately identifiable risk components, the ED included material in the basis for conclusions that could have affected the existing interpretation of what is considered as separately identifiable. In response to feedback on the ED, this text has been removed. The amendments introduce temporary relief from having to meet the separately identifiable requirement when an RFR instrument is designated as a hedge of a risk component. The relief allows, upon designation of the hedge, to assume that the separately identifiable requirement is met, provided the entity reasonably expects the RFR risk component to become separately identifiable within the next 24 months. The amendments require that the relief applies to each RFR on a rate-by-rate basis and starts for each rate when the entity designates RFR as a non-contractually specified risk component. The relief then ends at the earlier of either 24 months after the initial designation of the RFR component, or when the entity reasonably expects that the risk component will not be separately identifiable within 24 months after initial designation. In either of these cases, the hedge would be prospectively discontinued. There's no relief from the requirement for the risk component to be reliably measurable throughout the life of the hedging relationship, and any hedge ineffectiveness is recognised in profit or loss as normal. Tony, over to you.
As with phase 1 of the IBOR reform project, the IASB has added some new disclosure requirements, but these have been reduced since the ED and allow a bit more flexibility in how entities would choose to provide the disclosures. There are effectively 3 requirements. First, how the entity is managing its transition to risk-free rates, its progress, and the risk to which it is exposed arising from financial instruments due to IBOR reform. Secondly, designated by each significant IBOR benchmark quantitative information about the financial instruments that have yet transitioned to RFRs. And third, whether IBOR reform has given rise to changes in the entity's risk management strategy, and if so, a description of those changes. These changes mainly been made to because some of the quantitative disclosures that were previously required would be operationally somewhat burdensome to provide. And also, this really allows entities to use management information to a greater extent.
With regards to effective date and the transition requirements, the amendments are mandatory and effective for annual periods beginning on or after 1st of January 2021, with earlier application permitted. Application is retrospective, and hedging relationships must be reinstated once an entity first applies the amendments if the hedging relationship was discontinued solely due to changes required by IBOR reform, and it would not have been discontinued if the Phase 2 amendments had been applied at that time. An entity is not required to restate prior periods. Feedback on the ED identified that reinstating some hedges could be problematic. To address this, at the beginning of the reporting period in which the amendments are first applied, any discontinued hedging relationships that are reinstated must meet the qualifying criteria for hedge accounting after taking into account the Phase 2 amendments. Back to Tony.
Thank you, David. So to pulling everything together, now that Phase 2 has been published, the IASB has completed its programme of changes to the standards to address IBOR reform. And together with Phase 1, they've delivered a comprehensive suite of changes which will substantially mitigate the effects of IBOR reform on financial reporting. Well, now the amendments have been finalised, entities will need to complete their assessment of the accounting implications of the scenarios that they expect to encounter as they transition from IBORs to RFRs, and also to plan and execute their programs to implement the new requirements. Where the amendments introduce new areas of judgment, entities will need to ensure they have appropriate accounting policies and governance in place. And for additional disclosures, entities will need to ensure they can gather and present the information required. Time is running out, however, particularly for entities who are considering early adopting these requirements, these amendments for December 2020 year ends. At that point, I'll say thank you and goodbye, and I'll hand you back to David.
That brings us to the end of this video. We hope you have found it useful. Further EY guidance on the IASB's IBOR reform project can be found at ey.com/IFRS. Also, please look out for our more detailed video, which runs through the amendments with some application examples. Thank you for watching, and goodbye.